Hey guys, my name is Evan and welcome to Economics 101, your number one source for everything econ. So for months, the U.S. labor market looked surprisingly resilient. Employers kept hiring, unemployment remained relatively low, and many people believed the economy was slowing, but not breaking. Then we had the July jobs report, and suddenly the narrative changed. Not only did the U.S. economy lose jobs for the month, but previous reports were revised significantly lower, raising an even bigger question. Has the labor market been weaker than we thought this entire time? Today we're going to break down everything into simple terms. Here's what we're going to cover. Number one, what the July jobs report actually says and why economists were so surprised. Number two, why these numbers matter. Number three, what all of this could mean for the Federal Reserve, financial markets, and even your wallet. But before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy simple breakdown of economics, markets, job reports, please share and subscribe. Now let's hop into the video. So we're going to start with the headline everyone is talking about. The July employment report showed that the U.S. economy lost approximately 23,000 jobs, making it the first monthly decline in payroll employment in quite some time. That's a major surprise because economists were actually expecting the economy to add around 83,000 jobs. Instead of positive hiring, payroll growth slipped into negative territory. Now, before everyone immediately jumps to the conclusion that we're in a recession, it's important to understand what this report is actually measuring. The number grabbing all of the headlines is called the non-farm payrolls. This tracks the number of paid workers across most industries in the United States. It excludes farm workers, private households, employees, and a few other specialized categories. Every month, economists watch this report because jobs drive almost everything else. If businesses are hiring, people earn income. When people earn income, they spend money. That spending supports businesses, which then hire more workers. It's one of the biggest engines of economic growth. So when payroll growth suddenly turns negative, investors pay attention immediately. But there was another part of this report that may actually be even more important. The government also revised the previous 2 months of job growth sharply lower. Together, May and June were revised down by roughly 103,000 jobs. So why does this matter? Because revisions tell us whether the economy is actually stronger or weaker than we originally believed. Imagine you're looking at your bank account every week and think you've been saving money. Then a month later, the bank tells you that your balance was actually much lower the entire time. That's essentially what happened with the jobs report. The labor market didn't just weaken in July. It appears hiring had already been slowing for months. And that changes how investors, economists, the Federal Reserve, that changes how everybody interprets the overall economy. Naturally, that leads to the next question. If hiring is slowing this quickly, what's causing businesses to pull back? One reason this report shocked Wall Street is because the labor market had been remarkably for a long time. Many economists expected hiring to cool gradually, not suddenly reverse. So why might that change now? One reason is that higher interest rates take time to work their way through the economy. When the Federal Reserve raises rates, borrowing becomes more expensive. Businesses face higher financing costs. Consumers pay more for mortgages, auto loans, and credit cards. Companies often respond by slowing expansion plans, delaying investments, or becoming more cautious about hiring. So that doesn't happen overnight. Sometimes it takes many months before those effects show up in the employment data. So there's also another number in today's report worth paying attention to, the unemployment rate. And I'm going to do a whole video on the unemployment rate. But the decline in payrolls, unemployment remained relatively low at 4.1%. That tells us that the labor market isn't collapsing, but it's showing signs of cooling off. Think of it like driving a car. The economy may not be slamming on brakes, but it may have taken its foot off the gas for a little bit. And that distinction is incredibly important because the Federal Reserve has been trying to slow the economy just enough to bring inflation under control. So now the big question becomes, have they finally slowed things enough? Or have they gone too far? Quick pause, guys. If you enjoy simple breakdowns and want more easy to understand videos of the economy, inflation, interest rates, make sure to hit the like button and subscribe. It helps the channel tremendously. And you'll never miss the biggest economic stories that actually impact your money. Now let's get back into the video. So now that we've covered what happened in the jobs report and why it surprised so many economists, the next logical question is, what does this mean for the Federal Reserve? If you've been following this channel for a while, you know that the Fed has been trying to walk a very fine line. On one side, inflation remains above its long-term 2% target. On the other side, the Fed doesn't want to keep interest rates high for so long that it's unnecessarily the economy. For the past few years, the labor market has been one of the biggest reasons the Fed felt comfortable keeping rates elevated. As long as businesses keep hiring and unemployment stayed relatively low, policymakers could argue that the economy was strong enough to handle higher borrowing costs. So a decline of 23,000 payroll jobs combined with 103,000 downward revisions, it may suggest the labor market may be cooling faster than previously believed. The Federal Reserve doesn't want decisions based on a single report. Instead, officials look at trends. So if future reports continue showing weaker hiring, investors will likely become even more confident that the Fed is getting closer to lowering interest rates. They can eventually influence mortgage rates, auto loans, businesses, borrowing, and even credit card interest. That's why millions of people, not just investors, pay close attention whenever the reports are released. So naturally, once this data hit the market, investors immediately began trying to answer the question, does this increase the odds that the Feds are going to cut rates? We will have to pretty much just wait and find out. So moving to the next big question, what does this actually mean for you? What it means for me, if you're not an investor, is to look at job reports and think, why should I care? The reality is these reports affect far more than just the stock market. A slowing labor market can eventually influence everyday financial decisions. If you become more cautious about hiring, job opportunities become more competitive. Some companies might slow expansion plans. Others may delay filling positions. For looking for new jobs, that could mean longer searches and more competition. At the same time, if the labor market continues cooling and inflation keeps moving lower, the Federal Reserve may eventually have room to reduce interest rates. That could bring relief in areas like mortgage rates, business loans, and just other forms of borrowing. Of course, none of this happens just overnight. Economic policy works with delay. So today's job report won't immediately change your mortgage payment or credit card rate. But it does influence expectations about where the economy could be heading over the coming months. So another thing worth remembering is that one report doesn't define the economy. Economic data is noisy. Sometimes we get unusually short numbers. Sometimes we get unexpected weak numbers. That's why economists always look for confirmation in the future reports before declaring a major turning point. So while today's report certainly raises new questions, it doesn't provide all the answers. So we need upcoming inflation reports, consumer spending data, to be able to tell us if what we're going to be looking at in the future. So let's do a recap of what we learned today. The jobs report delivered one of the biggest surprises we've seen in quite some time. The U.S. economy lost 23,000 jobs, far below expectations. On top of that, May and June payrolls, they were revised down, and that combined to be like 103,000, suggesting that the labor market had already been weaker than many of us believed. While the unemployment rate remained relatively low at 4.1%, this report adds to the growing evidence that hiring is cooling off. For the Federal Reserve, that's important development. A softer labor market could eventually support the case for lower interest rates. For investors, businesses, and consumers, the next few economic reports will be increasingly important because they'll help us understand or answer whether this is an isolated surprise or the beginning of a broader slowdown. If you found today's video helpful, please hit the like button, subscribe, and share. And down in the comments, tell me what you think. Do you think this job report means that the Fed will cut interest rates sooner than expected? I'd love to hear from you. Again, this is Economics 101, your #1 source for everything econ, and I'll see you on the next video. Thank you.